Welcome to this week's Cornerstone Retirement University. This week we're going to be talking about one of my favorite subjects, which is the red zone. So this is for all you football fans out there. And by the way, Anthony, a little shout out to our Las Vegas Raiders.
Let's go. Win, baby, win.
That's right. So today we're going to be discussing the red zone financially. And the red zone, if you're a football fan, you understand that that is the 20 yards before you get to the end zone. And Anthony, there's a lot of things that can happen in that red zone, right?
Yeah.
What are some of the things that some teams are kind of known for doing?
Well, just like football teams, you have to have very detailed strategic approaches on how you're going to move the ball and how you're going to plan to score. Well, the financial red zone, we have to make sure that we're properly organizing, consolidating all of your accounts and putting a proper income plan. So number one is plan for your future retirement income. We don't want to do that after you already retire and figure out where we're going to get our income from. So part of that is looking at your Social Security, looking at your different investment and retirement accounts, and making sure we have sources coming in on a consistent basis to meet all your fixed income in retirement.
That's right. And Anthony, you know, these are all steps when you're in the financial red zone. But let's face it, sometimes these good NFL teams, they fumble in the red zone, right? They throw an interception. And this is what we're really trying to avoid for you. We're trying to avoid a snafu in the red zone where you throw an interception or you fumble the ball very close to retirement.
And now you got to work maybe an extra few years, 5 years, and it doesn't go as planned. So let's move on to number two, take advantage of the catch-up provisions. So many of you out there, you're within 10 years of retirement, and you can add additional funds to your 401k or retirement accounts with those catch-up provisions. And so strategic planning with your financial advisor leading up to your retirement years and maxing out those contributions could potentially be pivotal in giving you more income in retirement.
There's no secret, Anthony. The more that you build that nest egg and the accumulation, the more income you're going to have. And that leads to our next step, which is taxes, right? We want to make sure that in retirement, you guys are comfortable. And there's nothing more uncomfortable than paying the tax man, Anthony, and wondering, this is all I have left?
Yeah, that's right. So if you are leading up to retirement, understanding the tax statuses of your accounts are key. Very often we see people are overweighted and have many of their dollars in tax deferred accounts, which means every dollar you pull out is taxable. In addition to that, making sure that you don't pay too much Medicare surcharge tax, because the more income you take from retirement accounts could impact how much you pay there as well.
Yeah, so folks, listen, you know, if you're sitting there asking yourself, man, I'm 10 years from retirement and I don't want to mess anything up. I want to make sure that I retire on that date that I have in mind.
Yep.
We got to make sure that these things are planned for, that you're prepared, that when you get into that financial red zone, you score touchdowns.
Right.
And so the next phase of that would be risk tolerance. And Anthony, we talk about this a lot. I mean, we need to have a different type of risk tolerance going into retirement than we did growing our retirement. Why is that?
Well, it's a different game because in the accumulation years before you retire, you think, okay, the market fell in the past and it came right back and it'll just do that again in retirement. Well, it's a lot different because you're putting money in every 2 weeks into your 401k and you saw it rebound because those were your contributions and you're buying the stock market at a discount and it works towards your advantage. But when you're in retirement, you're no longer putting money in, you're doing the exact opposite. You're pulling money out every single year, and that could have a significant impact, especially in down markets, and you could potentially get yourself in a hole where it's hard to climb out of. So let's move on to number 5, and that's having a plan for income gaps if your spouse passes away. And this is so important. So again, the financial red zone is the 10 years before you retire and the 10 years after you retire. We have to look at if one spouse passes away, is the surviving spouse going to have enough to last? Are they going to be okay? And having plans to replenish those income gaps is key.
And you know, Anthony, a lot of people that we sit down with, they don't understand that when a spouse passes away, they lose that Social Security benefit. They
Right.
just think that they're going to keep getting paid.
Right.
And so the idea, folks, is that if one of you passes away, they'll let you keep the larger Social Security check, but the smaller one will go away and you'll have less income.
So real quickly, we'll end on plan for estate and legacy needs, understand how you're going to leave those assets in a tax efficient way, and then also lowering your fees. At the end of the day, the more fees you pay, the less income you have in retirement. So if you have any questions on any of the topics that we talked about today, call the number or go to our website, and we'll see you next week. Thanks.